This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, I'm Lee Adler, and this edition of Radio Free Wall Street was recorded Thursday, May 15th, 2015. Well, I have to wonder if the reports of a weak economy are misleading traders into being bullish and buying stocks, pushing them to all-time record highs. The issue about being misled is that maybe traders are buying stocks now because they think the Fed won't raise rates this year because of these reports of a weak economy. The hard data that I look at, the tax data, is not weak at all. As a matter of fact, it's showing signs of accelerating in April, and we now have all the monthly tax data in for April, and not only were individual income taxes at a record, but withholding taxes were strong again in April. Excise taxes, which are a volume-based measure of the economy, are accelerating. They've been accelerating since the beginning of the year, now up to close to a 4% annual growth rate. So these numbers, hard data that's never adjusted, it's never revised, is getting stronger. And we saw that again today, also in the initial unemployment claims, which are still running at record bubble levels. So the signs such as the GDP and the retail sales that the economy is slowing, I think are more a measure of the problems that we have with seasonally adjusted data than they are with what's actually going on in the economy. That being said, the retail sales were somewhat soft, and I'll take a look at that tomorrow. But I think the bet is in the market that the Fed is going to delay raising rates. I think the economic data is going to begin to push the Fed. It's probably behind the curve on inflation. We look at the bond market and we see it selling off, and bond traders tend to be a little more savvy about these things than stock traders are. So they probably smell a whiff of inflation in the air, and I think there's good reason for that. We're also seeing in recent weeks the dollar selling off and oil rallying. Those are opposite sides of the same coin. There are large leverage speculators, hedge funds, and wealthy individuals who use oil as a money substitute. We saw that trade break last year, but it may well be that it's coming back. And traders, large traders, get out of the dollar and into the oil futures, and the market there is coming back as well. So some of these signs indicate that inflation is on the way. With the stock market betting on a delay in the Fed raising rates, at the same time, I think the Fed is going to be under increased pressure to make a move sooner rather than later, and to be more aggressive about it than they intend initially. They're going to have problems when the time comes getting rates to go up at all with all this excess cash in the system. The Bank of Japan is still pumping. The ECB is still pumping cash into the system. Much of that cash flows into the U.S. banking system. You have the same players in the Bank of Japan pool and the ECB pool that have accounts in the U.S. that are active in all of these major markets are playing in the U.S. pool. So some of these funds are coming into the U.S. still. Also this week, the Fed settled its mid-month MBS purchases. That total, we got the numbers on that today for the last 30 days. And the total settlements for this week are now going to be $38 billion to the primary dealers. That's a lot of cash. That's certainly going to put upward pressure on prices. I think that's a big reason for what we saw today, because $26 billion of that $38 billion settled yesterday. So all that cash flowed into these dealer accounts. And the next thing you know, you have stocks breaking out. There's a quid pro quo there. We've followed this for years, and we know that it works. As the weeks and months go on, I think the economic data is going to begin to reflect what we already know